Contrarian thinking. When others are fearful, I look for opportunity. There are times in my life when the world seems to be moving in one direction, the direction of optimism, of money flowing into the market, of cheers as assets rise. People line up to buy stocks like lottery tickets, pour money into real estate as if it will never fall. The media calls it a golden opportunity. Social media calls it a trend. But I, and a few others, see the opposite. We don't expect prices to rise. We look for anomalies in the jubilant crowd. We listen for overlooked facts, read financial reports like battlefield maps, and ask uncomfortable questions. Why are prices so high? How much is this asset really worth? That's contrarian thinking. Not emotional rebellion, but independence in analysis, clarity of observation, and courage in action. When markets begin to burst, whether it's the 2008 real estate bubble, the 1992 pound sterling bubble, or the various stages of the Chinese, US, and Japanese stock markets, short sellers are often blamed. They are called opportunists, magicians, even destroyers. But the truth is, we didn't break the market did it. We were just early adopters who saw what was wrong. Short selling is by its very nature a mirror that holds up the hidden truth. It forces people to look at inflated financial beliefs, sanitized numbers, and paper-only business models. And while the masses are still dreaming of a bull market forever, short sellers are already preparing an action plan when things go wrong. The book you are holding in your hands is not a get-rich-quick scheme. It is not a money-making formula. It is a journey of thinking, of how the world's top speculators have looked at reality differently, and therefore created different results. I believe that in any market, whether it is rising or falling, whether it is in a crisis or in prosperity, there is always an opportunity for those who can observe, analyze, and act earlier than the majority. You may not be George Soros, but you can learn to think like him. And in a world where risk always lurks behind financial dreams, contrarian thinking is the most important survival skill you can possess.
Contrarian thinking. When others are fearful, I look for opportunity. There are times in my life when the world seems to be moving in one direction, the direction of optimism, of money flowing into the market, of cheers as assets rise. People line up to buy stocks like lottery tickets, pour money into real estate as if it will never fall. The media calls it a golden opportunity. Social media calls it a trend. Chapter 1. The nature of short selling, profiting from a crash. In the world of investing, there is a seemingly unbreakable principle. People buy assets because they expect them to rise in value. From real estate to stocks to gold to cryptocurrencies, the belief that prices will rise is what keeps money flowing through the markets. But there is a small group, a minority, who don't believe that. They don't expect prices to rise. They don't celebrate when the market goes up. They make money by going against everything. They are the short sellers. Short selling is the act of borrowing assets at their peak, selling them on the market, then waiting for the price to drop, then buying them back at a lower price to repay, profiting from the difference. This is a form of contrarian investing, betting on collapse rather than growth. It sounds like a ruthless strategy, like a tiger waiting for its prey to fall. But the truth is, short selling did not cause the crisis. It was the result of overinflated economic bubbles. Short sellers are simply those who see the truth before others and dare to act. The real value of short selling is not financial tricks, but critical thinking and the ability to read the market when no one dares to believe the facts. It is not black magic, as the media calls it. It is the art of reading the collapse trend, where a brave investor steps into the fear zone and uses reason to swim against the tide.
Chapter 2. The legendary speculators, Livermore, Burry, Soros, and the magicians. If you ask a typical investor who they idolize in the stock market, the most common answer will probably be Warren Buffett, the sage of Omaha with his philosophy of value investing, long-term holding, and calm as a rock in the face of market turbulence. But if you step into Wall Street, to the places where trading is boiling every second, and ask speculators who live by the pulse of the market who they idolize, the answer will be very different. They do not look at those who hold stocks for 10 years. They look at those who break the rules, the masters of crowd psychology, and those who dare to bet against the world. They call these people magicians, not because they do bad things, but because the way they make money is both feared, admired, and inexplicable. And the three names that often appear on that list are Jesse Livermore, Michael Burry, and George Soros. Jesse Livermore, ahead of his time. Born in 1877, Jesse Livermore was one of the first people to make millions of dollars by shorting stocks during the most turbulent period of the U.S. market. He became famous for his contrarian trades, especially in 1929, when the whole U.S. was optimistic that stock prices would never collapse. While the crowd was buying at all costs, Livermore secretly borrowed stocks to sell, preparing for the day he was sure would come, the day the market burst. When the Great Depression of 1929 occurred, millions of people lost everything, but Livermore made more than $100 million, a huge number at that time. He was not perfect. He also failed and went bankrupt, but he left behind a great philosophy. Never argue with the market. Observe and act before others understand what is happening. Michael Burry, the man who saw the end of the bubble. Michael Burry, a medical doctor turned fund manager, is famous for his bet against the U.S. real estate market in 2008. In a financial world full of superstitions about ever-increasing house prices, Burry quietly analyzed hundreds of mortgage applications and discovered a horrifying thing. Most of these loans were unpayable. While the whole Wall Street was full of optimism, he spent money buying financial insurance contracts, or CDS, to bet that the housing market would collapse. People laughed at him, calling him crazy, but when the crisis happened, he earned more than $700 million in profits for investors and was recorded in history in the famous documentary, The Big Short. Burry is a testament to the power of factual analysis over popular belief. George Soros, the man who broke the Bank of England. If there is anyone who both inspires respect and fear in the finance world, it is George Soros. In 1992, during a historic exchange rate war, Soros realized that Britain was keeping the pound too high while its economy was weakening. He borrowed tens of billions of pounds and sold them all at the same time, creating huge pressure on the currency. Although the Bank of England tried to defend themselves by raising interest rates to 15%, they could not stop the decline. The result, the pound collapsed, the British government was forced to withdraw from the European exchange rate system, and Soros pocketed $1 billion overnight. Not stopping there, he continued to shock Southeast Asia in 1997 when he bet against weak currencies that were being gold-plated by hot money. Countries like Thailand, Indonesia, and South Korea fell into currency crisis, and Soros was once again labeled a ruthless speculator. But he once said, "I don't cause crises. I just see the whole and act before it blows itself up." Witchcraft or genius? Some worship them, some hate them, but no one can deny that. Livermore, Burry, Soros, and many others have left an indelible mark on the history of world finance. They were not lucky. They were people who understood that markets are not always rational, and that it is in the most irrational moments, when the crowd is lost in illusion, that the contrary can change the whole game.
Chapter 2. The Legendary Speculators. Livermore, Burry, Soros, and the Magicians. If you ask a typical investor who they idolize in the stock market, the most common answer will probably be Warren Buffett.
the sage of Omaha, with his philosophy of value investing, long-term holding, and calm as a rock in the face of market turbulence. But if you step into Wall Street, to the places where trading is boiling every second, and ask speculators who live by the pulse of the market who they idolize, the answer will be very different. They do not look at those who hold stocks for 10 years. They look at those who break the rules, the masters of crowd psychology, and those who dare to bet against the world. They call these people magicians, not because they do bad things, but because the way they make money is both feared, admired, and inexplicable. And the three names that often appear on that list are Jesse Livermore, Michael Burry, and George Soros. Jesse Livermore, ahead of his time. Born in 1877, Jesse Livermore was one of the first people to make millions of dollars by shorting stocks during the most turbulent period of the U.S. market. He became famous for his contrarian trades, especially in 1929, when the whole U.S. was optimistic that stock prices would never collapse. While the crowd was buying at all costs, Livermore secretly borrowed stocks to sell, preparing for the day he knew would come, the day the market burst. When the Great Depression of 1929 occurred, millions of people lost everything. But Livermore made more than $100 million, a huge number at that time. He was not perfect. He also failed and went bankrupt. But he left behind a great philosophy. Never argue with the market. Observe and act before others understand what is happening. Michael Burry, the man who saw the end of the bubble. Michael Burry, a medical doctor turned fund manager, is famous for his bet against the U.S. real estate market in 2008. In a financial world full of superstitions about ever-increasing house prices, Burry quietly analyzed hundreds of mortgage applications and discovered a horrifying thing. Most of these loans were unpayable. Dissecting a short sell, Luckin Coffee, and Muddy Waters. In the midst of rapid technological growth and a wave of Chinese startups flooding Wall Street, there was one name that was once considered a coffee unicorn, Luckin Coffee. Launched just over a year and a half before going public, the company stunned the world with its miraculous expansion speed. People compared it to Starbucks. The media called it the new symbol of modern China. But then, in less than 2 months after entering the NASDAQ, Luckin's stock price plummeted 80%. The empire collapsed. The CEO resigned. The leadership was investigated, and investors were left with nothing. Behind that lightning-fast collapse was a familiar name in the short-selling world, Muddy Waters. The one who exposed the glamorous cover. Muddy Waters is one of the most prestigious and effective short-selling firms in the world. There were no hundreds of employees or fancy headquarters. The entire company consisted of only about 5 people, led by founder Carson Block. But they were the ones who caused many listed companies to bow their heads and withdraw from the stock exchange because the truth was exposed. With Luckin Coffee, Muddy Waters did not act recklessly. They spent months on the ground surveying before making the decisive move. Their plan was very methodical, almost like an economic intelligence campaign. Field investigation strategy, when magic is observation. They hired more than 1,500 university students, divided into hundreds of Luckin coffee shops across China for weeks. The students' jobs were simple: videotaping the number of customers coming in and out, recording peak hours, taking pictures of receipts, observing the number of products sold. All the data collected was then analyzed. On average, each store had only a few customers per hour. Many invoices were faked and duplicated. Revenue was inflated by over 80%, and the selling price was also inflated by over 10%. In addition, Muddy Waters also discovered something extremely suspicious. The company's leaders secretly sold nearly 49% of the shares they held after listing, a clear sign of taking profits at the top and fleeing the sinking ship. All of this data was compiled into a detailed report, dozens of pages long, with video evidence, and publicly announced to the entire market. Within a few days, investors lost confidence. Luckin shares collapsed like a domino effect. Strategic lesson: win with the truth. The scary thing is not the short selling itself, but the sobriety and discipline in the approach of professional speculators. Muddy Waters does not act on rumors, emotions, or unverified news. They rely on real data, on-the-ground investigations, and point out the mismatch between market expectations and the actual state of the business. This strategy is not new, but it works because the truth, when exposed with concrete evidence, is always more powerful than any PR campaign. Can the average person do it? You may be thinking, I don't have a team. I don't have time to investigate. How can I short sell like Muddy Waters? The answer is, you don't need to become an investigation firm. You just need to learn to ask the opposite question.
For example, why is a company growing unusually fast in a fiercely competitive industry? Is the company's leadership constantly selling shares? Are revenues consistent with actual consumer data? Is the company using accounting tricks? Such information is not out of reach. They're revealed in financial reports, trading systems, or even if you just look more closely at what's going on around you. Trust and slander, two extremes that need to be balanced. The stock market is built on trust, but blind trust is the easiest thing to betray. Crashes like Luckin Coffee are proof that listing does not mean transparency, technology does not mean breakthrough, and cash flow does not mean lasting value. In today's financial landscape, the winners are not the fastest, but the sanest. Muddy Waters taught us a simple truth. Look for the big bubbles and be the first to puncture them with the truth.
Chapter 4: Market Psychology and Crash Signals. Finance is more than just numbers. Behind every price chart is human psychology, greed, expectation, panic, and illusion. Understanding market psychology is understanding the pulse of money, and for short sellers, it is the compass that guides the way, because every crash starts with a dream that is too beautiful. When greed overshadows reason. Any asset bubble, from real estate, stocks, to cryptocurrencies, starts with a compelling story: rapid growth, world-changing technology, life-changing opportunity. People don't buy assets because they are worth it, they buy because everyone else is buying. And if everyone thinks the price will go up, no one wants to miss out. So they buy because they are afraid of missing out, a state that psychologists call FOMO, fear of missing out. During this phase, the media is hyped. Financial speakers are everywhere. People who have never invested before start to place orders. This is the first sign of a possible crash, when the market is no longer driven by value, but by collective emotion. The top is the most dangerous place. Livermore once said, "When you see the shoe shiner starting to recommend which stocks to buy, that's when you should sell." When an asset becomes the talk of the coffee shop, when the market price no longer reflects its real value, that's when short sellers start to prepare for action. They are in no hurry. They observe. Stock prices rise, but trading volume falls. Good news comes out continuously, but the price begins to react weakly. Insiders, management, major shareholders start to sell stock. These are early signals, like the wind before a storm. Not loud, but clear to anyone sober enough to listen. When the truth is exposed, fear becomes a weapon. The crowd is very good at believing what they want to believe. But once the truth is exposed, even if it is just a small question mark in a financial report, a rumor of wrongdoing, or a sign of negative cash flow, that belief immediately turns to panic. The market has a ruthless nature. Prices rise slowly, and prices fall as fast as a knife. Panic psychology does not follow logic. When investors start to sell off to preserve capital, the more they sell, the more prices fall. The more prices fall, the greater the fear. And so the domino effect occurs. forcing even those who once believed with all their might to run away with the crowd. In psychology, this is called panic behavior, herd behavior, and an extreme state. That is the moment of the short seller. Technical signals do not lie. In addition to psychology, technical signals also play an important role in determining the point of collapse. Professional short sellers often closely monitor long-term support lines. When broken, it is a sign of wavering confidence. Sudden increase in selling volume, a sign of large cash flows being withdrawn. Price increases without volume, a sign of fake price push. Technical analysis is not fortune-telling. It is a set of signs of human behavior, expressed through price and trading volume. When familiar patterns repeat, experienced people will see the scenario in advance. Distinguishing between corrections and collapses. Not every price drop is a sign of short selling. The market still has healthy corrections. So how to distinguish between temporary corrections and systemic collapse? Some signs that the market is about to really crash are assets are overvalued, PE, PB are far above average, market-wide margin debt is at record levels, company market share or revenue growth is slowing, unhealthy financial structure, negative cash flow, high short-term debt, unusual behavior of company leaders, withdrawal of capital, issuance of additional shares, transfer of assets abroad. When you see 3 to 4 of the above signs at the same time, it is time to seriously consider a short selling strategy.
Chapter 5. Shorting Stocks, Strategies, Tools, and Risks. If traditional investing is a game of faith in the future, then short selling is the art of seeing collapse from within. In this chapter, we will enter the technical part of the world of short selling stocks, where knowledge, discipline, and strategy are the 3 vital factors. 1. What is short selling? Understand the nature. Short selling is a form of speculation that allows you to profit when the price of a stock falls. The basic process consists of 4 steps. Borrow shares from a brokerage firm, broker. Sell to the market when the price is high. Wait for the price to fall. Buy back the shares at a lower price and return them to the lender, earning the difference. For example, you borrow 100 shares of XYZ stock that is trading at $50. Sell them for $5,000. Then the stock price drops to $30. You buy it all back for $3,000, return the stock, and keep the $2,000 profit. It sounds simple, but in reality, it requires you to analyze the trend extremely accurately. Because if the direction is wrong, you will not only lose money, but lose more than your capital. 2. Effective short-selling strategies. Here are some strategies commonly used by professional speculators. A. Trend following short. When the stock breaks the long-term support line, accompanied by large trading volume, investors sell short following the decline. B. Mean reversion short. The stock increases too quickly compared to the reasonable valuation, creating a large deviation from the real value. At that time, investors bet that the price will return to normal levels. C. Short selling based on fundamental analysis. Fundamental short. When you discover a company with fraudulent financial reports, debt, an unsustainable business model, or inflated profits, this is the ideal time to place a short sale order. D. Short selling according to the pump and dump model. Some stocks are pumped up by the media, celebrities, or investment groups, then quickly lose value. Smart speculators will seize the moment to dump to short sell. 3. Short selling support tools. To short sell stocks, you need to use the right tools and platforms. Margin account,
allows you to borrow stocks from a brokerage firm. Technical analysis, identify market entry-exit points based on price charts, volume, RSI, MACD, Bollinger Bands indicators, etc. Insider trading data, monitor whether company leaders are selling stocks. Quarterly and annual financial reports, cash flow analysis, interest expense, revenue growth. List of stocks that are being shorted the most, short interest, shows the level of skepticism about each stock. 4. Risks of short selling. The price of going against the crowd. Unlike buying stocks where the maximum risk is losing 100% of your capital, short selling has unlimited risks. For example, you short sell a stock at $50, but for some reason the price increases to $150. You are forced to buy it back at 3 times the price, causing a heavy loss. Main risks. Unlimited loss. The stock price can increase indefinitely. Margin call. If the stock increases, you will have to deposit more money to maintain the position. High stock borrowing fee. The brokerage firm charges interest on the stocks you borrow. Short squeeze. If many short sellers sell at the same time, the price can skyrocket as they rush to buy back to cut their losses, causing the price to rise even more. Legal risk. Some countries restrict or ban naked short selling because it destabilizes the market. 5. Cut losses and control risks. Lessons for survival. Like a swordsman going upstream to cut through a sea of people, a short seller must know when to draw his sword and when to back off. Always set a stop loss. Do not let your losses exceed a manageable level. Do not put all your capital into one trade. Diversify your targets. Do not short stocks with too little liquidity. Stay up to date with news related to that stock and industry. Remember, the risk is not in the market. It is in you entering without understanding the rules of the game.
Chapter 6. Forex Short Selling, Long-Short Strategy, and the Exchange Rate War. If short-selling stocks is a game played within the domestic financial market, then short-selling Forex is a global war, where money becomes a weapon, interest rates are ammunition, and governments are players forced to fight for the survival of the economy. This is no longer sharks versus small fish, as in the stock market, but sharks versus central banks, where a successful short sale can take down a country's entire currency. 1. The nature of Forex trading. Forex, foreign exchange, is the world's largest financial market, where currencies are bought and sold in pairs. Each transaction is never buying a single currency, but betting on the relative strength of 2 currencies. For example, when you short the GBP-USD pair, it means you bet that the British pound will weaken against the US dollar. In Forex short selling, you don't need to own any currency in advance. Just open an order and the system automatically understands that you are trading in the direction of the price decrease of one side. 2. Long-short strategy, double-edged weapon. The long-short strategy in Forex is a form of shorting a weak currency and buying a strong currency, thereby profiting from the exchange rate difference when fluctuations occur. The special thing is, unlike stocks, price can increase forever, decrease forever. Forex is relative. If one currency is weak, the other currency is strong, and vice versa. Typical example? In 1992, George Soros shorted the British pound by borrowing a large amount of British pounds, selling it for German marks, stronger. When the pound depreciates, buy back the pound at a low price, pay back the loan, make a huge profit. His strategy is simple but effective, because he understands that when a country wants to lower interest rates to stimulate the economy, their currency will weaken, and countries that raise interest rates will strengthen their currency. 4. The story of Thailand 1997, when the baht was sold off. In 1997, the Thai economy was growing hotly, relying on foreign investment flows into real estate and stocks. But behind the prosperous appearance were continuous trade deficit, foreign debt amounted to more than $100 billion. Foreign exchange reserves were only $30 billion. Soros and many hedge funds realized that Thailand was not strong enough to defend the fixed exchange rate of the baht with the USD. They began to borrow baht from domestic banks, dumped it on the market, putting pressure on the exchange rate. The Bank of Thailand tried to cope by injecting USD to buy back baht, rapidly depleting reserves, raising interest rates, suffocating domestic businesses. Finally, Thailand was forced to float the exchange rate. The baht lost nearly 50% of its value in just a few weeks, starting the Asian financial crisis. 5. Short-selling Forex for beginners. Is it possible? The Forex market is now very open, and there are many trading platforms that allow small investors to participate. But to avoid falling prey, you need to understand macro factors, interest rates, inflation, monetary policy, know how to read economic data, CPI, GDP, foreign exchange reserves. Use leverage wisely. Forex allows for very high leverage, but remember, it amplifies both profits and losses. Set your stop loss correctly. Never let a short sell go without a stop loss. With the right strategy and good risk management, shorting Forex can be a great source of income, even when global markets are in turmoil. 6. Special note. Don't fight central banks if you're not strong enough. You can't always beat countries. Soros beat the UK, but he also lost when shorting the Japanese yen because the Bank of Japan had too much power and was ready to intervene at any time. Survival rule? Short only when you're on the side of the trend. If the central bank wants to defend the exchange rate, but the fundamentals don't support it, you win. But if you short and the bank has a good reason and is strong, get out before you get crushed.
Chapter 7. Fragile States. From the pound sterling in 1992 to Southeast Asia in 1997. Because currencies are not only a means of payment, but also a symbol of a country, each successful short sale of a national currency is a serious blow to reputation and market confidence. Financial crises come not only from fraudulent companies, but sometimes from governments that have lost control of their own economies. In this chapter, we will analyze countries that have become typical victims of systematic short-selling campaigns. To understand what makes an economy fragile and why does a single spark burn down an entire system. 1. Pound sterling. Political egos crushed by money flows. In 1992, the UK attempted to keep the pound sterling in fixed exchange rate system called the European Exchange Rate Mechanism, ERM, alongside major European currencies such as the German mark. The problem was, the British economy was in a recession. It needed to lower interest rates to stimulate growth. But to protect the exchange rate, they were forced to maintain high interest rates, which ended up killing domestic businesses. George Soros saw the paradox. He wasn't against British policy, he was just betting on something that couldn't last. You can't keep your belt tight and your body in shape. At some point, the belt will break. Soros and major hedge funds shorted tens of billions of pounds. The Bank of England responded by injecting foreign exchange reserves to buy pounds. Interest rates were raised from 10 to 12%, then 15% in the same day, all to no avail. In the end, Britain withdrew from the ERM, the pound fell sharply, and Soros made more than $1 billion in profits overnight. From then on, he was dubbed by the media as the man who broke the Bank of England. 2. Southeast Asia, the hunted tigers. Just a few years later, in 1997, a new earthquake occurred in Asia.
The economies once known as the Asian tigers, Thailand, Indonesia, South Korea, Malaysia, began to collapse within months. The reason? Hot growth based on short-term USD debt, fixed exchange rate policy with the US dollar, persistent trade and fiscal deficits, thin foreign exchange reserves vulnerable to speculative attacks. The scenario repeats itself, like the UK. International hedge funds borrow local currency, then sell. Currency depreciates. Central bank pumps reserves and raises interest rates to prop up. Domestic businesses suffocate. Bad debts explode. The economy collapses. The only difference is that no country has the financial strength to save itself, and no one can borrow as much as the West. From Thailand, the crisis ripples across Asia, then Russia, Brazil, and finally Wall Street in 1998. 3. Why are these countries vulnerable? Countries that become short-selling targets often have the following characteristics in common. Impact factors. Fixed exchange rates. Susceptible to speculation due to lack of flexibility. High foreign debt. Easily depleted foreign exchange reserves when attacked. Short-term investment flows. When withdrawn, the market collapses immediately. Low interest rates and high inflation. Currencies lose their appeal. Lack of beta transparency. Weak investor confidence. In other words, short selling is just a finger pressing down. A weak economy is already a dry branch. 4. Lessons for today's countries. The Southeast Asian crisis is not an event of the past. Every year, these signs are repeated in many places, from Turkey, Sri Lanka, Argentina, to Pakistan. The globalized world makes a country that is economically unbalanced becomes an immediate target. That also means, if you are an investor, you can read these signals early to prepare for short selling. If you are a country, you need to prepare yourself internally to withstand the financial storm.
Chapter 8. Naked short selling, when you don't need the asset to make a profit. Most of us think that to sell something, you have to own it. But in the financial world, especially for seasoned speculators, that's not entirely true. Naked short selling is a technique in which the seller doesn't actually own or even borrow the asset, but still sells it on the market with the belief that the price will fall and they will buy it back at a cheaper price before they have to deliver it. This is a sharp, dangerous weapon, and also a very unconventional strategy where timing, information, and crowd psychology play a key role. 1. The nature of naked short selling. Unlike normal short selling, where you have to borrow stocks or assets before selling, naked short selling takes place without the asset in hand. The basic process. You place an order to sell an asset, stock, foreign currency, futures, without owning it. After the price drops, you buy the asset back at a cheaper price. Complete the transaction by late delivery or by clearing in the payment system. In theory, this is a form of sell first, calculate later, and when done at the right time, it can create a fake supply, causing the price to fall rapidly, creating the effect of demand does not buy, supply rushes to sell. Application in the real market. A. Foreign exchange market, Forex. Forex is the perfect environment for naked short selling because 1. Does not require owning the real asset. 2. Trade in currency pairs. 3. High liquidity, 24/7 market. You can sell the pound even if you do not have any pounds in your account, as long as you buy it back at the right time to cover it. B. Futures. Futures contracts do not require physical possession of the commodity, so speculators can place short-selling orders on gold, silver, oil, coffee, corn, sugar, interest rates, stock indexes. As long as the expiration date comes, you close the position by buying back the contract or making a payment with the difference. C. Stock market before 2008. Before the global financial crisis, many investors shorted U.S. stocks. Even without borrowed shares, they still sold,
waiting for the price to fall to buy back. The chaos caused by short selling caused some companies to collapse in just a few days. Lehman Brothers is an example. Therefore, the U.S. Securities and Exchange Commission, SEC, after 2008, completely banned this form in the stock market. Advantages and risks of short selling. Advantages: no need to borrow assets in advance. Legal risks, if banned. Can act quickly, take advantage of fluctuations. Unlimited losses if the price moves in the opposite direction. No need to borrow fees or large initial margin. May not have enough liquidity to buy back. Virtual supply effect causes the price to drop sharply. May be subject to margin calls or heavy fines. The key to success is speed, accurate market orientation, and compliance with the rules of each specific market. 4. A parable: borrowing a car to sell first. To simplify, imagine the following story. I don't have money to buy a car. My neighbor has a Tesla. I asked to borrow it to pick up my girlfriend, but in fact, I sold it for $30,000. Then I spread the rumor, Tesla has a brake problem. The news spread, the market panicked, and the car price dropped to $10,000. I bought an identical car for a cheaper price, cleaned it, and returned it to my neighbor. My profit? $20,000. Of course, this is just an example to illustrate the concept of short selling, exploiting information gaps and speed to profit from the imbalance in supply and demand. Why is short selling considered evil? Not because it is inherently wrong, but because it creates chaos if abused. When too many people short sell, the market becomes distorted because of the unreal supply. Panic spreads quickly, creating a domino effect on prices falling sharply. Weak companies are easily attacked and collapse quickly, causing a chain reaction to the entire system. That is why many countries ban it completely or only allow it in markets with sufficient liquidity and control. When to use this strategy? When you have a definite bearish trend but have not borrowed assets yet. When the market allows for legal short selling, for example in Forex. When you need to react quickly to unexpected news that could cause a sharp price drop. However, you should be extremely cautious and use it only in small ranges, because you will have no defense if the market reverses.
Chapter 9: Ethics, Boundaries, and Sanity. When finance is more than money. In previous chapters, we have gone through sharp tactics, famous short sales, and financial crises where a well-timed short was enough to rewrite history. However, finance is not just a game of numbers, charts, and profits. It is also a field that touches the real lives of millions of people. And with such great power, it always comes with questions that are never easy to answer. Do I have the right to short a company that I believe is about to collapse, knowing that doing so will put thousands of people out of work? Should I spread negative news, even if it is true, if I know it will cause a market panic? Where is the line between exposing the truth and inciting a panic? 1. Is short selling immoral? This is a question that is often asked when the market is down and the media needs a culprit. Names like George Soros, Muddy Waters, Michael Burry have been accused many times of being the one who ruined the market, the one who took advantage of the situation. However, let's look at the nature. Short selling does not create fraud. It only reflects the truth that the market has not seen or intentionally ignored. If a company is doing business honestly, with a solid foundation, no one can short sell it to collapse its true value. Short selling is a warning signal to the market that something is wrong, and wrong enough that people are willing to bet their fortunes to prove it. The danger lies not in the act of short selling, but in the values that are being inflated, hidden, and imagined. 2. The line between expose and incite. However, there is a fine line between reporting honest financial statements and exaggerating negative details to create negative psychological effects. A short seller might publish a series of investigative videos, as Muddy Waters did with Luckin Coffee.
But if a speculator makes up stories and uses unverified rumors, he is no longer exposing the truth. He is manipulating the market. Modern financial markets come with a monitoring mechanism. Countries have short-selling regulators. Some regions require short-selling positions to be disclosed if they exceed certain thresholds. Deliberately manipulating prices with fake news is illegal. So short sellers need to be alert. You are not just shorting with your capital. You are also shorting with your reputation and professional ethics. 3. Profit is not the only goal. In the financial journey, no one denies the role of profit. But what separates a professional player from an opportunist is how they control risk, discipline, and responsibility for their own actions. Short selling requires intelligence, but also self-respect. No one can win the market forever, but a person who maintains his sanity and conscience after many years of trading, that person has truly won. I have met people who made millions of dollars from short selling, but eventually quit because they could not bear the feeling of seeing the market bleed every time they succeeded. I have also met people who held short positions even when they knew insider information that could save the company, just because they wanted to make sure they completely crushed it. They are all very good, but only a few of them are truly respected by others. 4. The market needs builders and destroyers. There is no denying the role of long-term investors, those who believe in the future, in sustainable growth. But the market also needs contrarians, those who are willing to shatter illusions and clean up the system. No one wants to be shorted, but if you are not worth what you think you are, sooner or later someone will point it out. The problem is not your behavior, but how you treat the power you hold.
Chapter 10. Conclusion. Lessons from the crisis and the future of contrarian investing. By the time you turn the pages of this book, you will have probably seen the markets in a somewhat different light. Short selling, long labeled as dangerous, immoral, or even a financial crime, now appears in a different light. A sharp strategy, an independent way of thinking, and a voice of reason in an overly optimistic crowd. History has proven that all markets fluctuate between boom and bust. No trend lasts forever, no belief is inviolable, and no bubble does not burst. 1. What a crisis leaves behind is more than ruins. Every financial crisis, whether it was in 1929, 1997, or 2008, has left millions of people with lost wealth, hundreds of businesses bankrupt, and the global economy in shambles. But at the same time, it also purifies the system, eliminates weak, fraudulent companies, forces governments to reform and be more transparent, makes people aware and learn to control risks. It is also during these times that short sellers act as system health checkers, uncovering loopholes and revealing the true value of assets. 2. The future belongs to those who dare to think differently. In an era where data is generated every second, social media spreads news in minutes, and AI can suggest stocks with just a click, the biggest advantage is no longer speed, but critical thinking. Anyone can read the news, but only a few understand what is behind the words. Anyone can buy the trend, but only contrarians survive when the bubble bursts. Contrarian thinking isn't stubbornness. It's the ability to question when everyone else believes in something, the patience when the market goes against your beliefs, and the courage to fight alone. 3. Lessons for the aspiring investor. At the end of the day, if you remember only 3 things from this book, remember 1. Bubbles are always there. You just have to learn to recognize when they're about to pop. 2. Short selling isn't a gamble. It's an analytical, disciplined, and ethical practice. 3. Contrarians don't seek fame. They seek the truth and bet on it before the world knows it. 4. The future of short selling in a new world. Technology is changing finance. Algorithmic trading is increasingly important. Blockchain creates new decentralized markets. Virtual assets, NFTs, cryptocurrencies open up unprecedented opportunities and risks. But one thing remains constant. When there are excessive expectations, there will be bubbles. And when there are bubbles, they will be short sellers. The truth is,
The more people forget history, the greater the opportunity for those who remember it. Final word. Choose the side of truth. I did not write this book to encourage you to become a market hunter. I wrote it to help you realize that in the midst of euphoria, you need to be sober. In the midst of the crowd, you need to have your own opinion. And in the midst of investment choices, you need to remember that the truth is always the most expensive thing. Whether you choose to invest long-term or short, whether you follow the trend or go against it, stay disciplined. Because the market punishes greed and ignorance, but it rewards those who are humble, sober, and act before the crowd sees the obvious. Good luck on your investing journey, and stay sober amid the financial waves.